Why is money flowing from Tokyo to Mumbai? The real game behind Japan's billion-dollar bet on India. In a Tokyo boardroom meeting, a few faces look unusually serious. Several country names are glowing on the screen. Vietnam, Indonesia, America, Europe. And then one name is being circled in red again and again. India. The question is not just where to invest money. The real question is which country will generate growth over the next 10, 20, or 30 years. The fear is that if Japan's biggest banks and companies choose the wrong market, their next decade could get trapped in stagnation. And the curiosity is, what exactly has changed so much that a long-favored manufacturing hub like China is no longer at the center, and India has now become the core of Japanese giant strategy? The signals coming from Japan toward India in recent times are not just ordinary business headlines. This is the story of a major strategic realignment. Mizuho Financial Group's global CEO, Masahiko Kato, recently said that India has emerged as the most promising destination for Japanese companies, and India-related client inquiries rose by more than 50% in 2024 alone. He clearly said that their strategy is to build an India-Japan corridor, one that supports both Japanese companies entering India and Indian companies expanding abroad. This is not just one bank's excitement. According to the 2024 survey report of the Japan Bank for International Cooperation, or JBIC, India remained the most promising country for Japanese manufacturing companies for the third consecutive year, while China slipped to sixth place. This is not a small change. It means that in Japanese boardrooms, India is no longer an optional market, but a priority market. If you look only from the surface, you will see separate deals. Somewhere a stake purchase, somewhere an acquisition, somewhere a partnership. But when all of them are placed together, the picture starts becoming very clear. Sumitomo Mitsui Banking Corporation, or SMBC, made a deal to buy a 20% stake in Yes Bank, valued at about $1.58 billion. Later, regulators also approved it, and the RBI allowed SMBC to increase its stake up to 24.99%. On the other hand, MUFG moved ahead with the process of buying a 20% stake in Shriram Finance, which Reuters described as one of the biggest foreign investments in India's financial sector. Mizuho decided to take a majority stake in Aventus, and Daiwa made a minority investment in Ambit Wealth. These are not scattered headlines. This is an organized march of Japanese financial capital toward India. Now the question is, why is Japan doing this? One answer lies in India's strength, and the other lies in Japan's compulsion. India is still counted among the fastest growing major economies in the world. According to the IMF, India's real GDP growth is estimated to remain around 6.2% in 2025 and around 6.3 to 6.4% in 2026. IMF country data also shows that India's population has now reached around 1.48 billion. That means Japanese companies are not just looking at a big market, but at a massive consumption engine. While listing India's structural strengths, Masahiko Kato spoke about a market of more than 1.4 billion people, strong consumption, a powerful digital ecosystem, and technology talent. This is not just diplomatic praise. India's digital public infrastructure has now become a global case study. According to government and industry sources, UPI is handling about 49% of the world's real-time payment transactions. In 2024, UPI transactions reached 13,116 crore, and its adoption has deeply formalized retail payments. For Japanese institutions, this is a huge deal, because wherever digital rails are strong, the possibilities for lending, wealth management, merchant finance, and cross-border services multiply several times. India's story is not limited to payments. The expansion of financial inclusion is also the backbone of this story. According to government figures, the Financial Inclusion Index reached 67 in 2025, and Jan-Dan accounts crossed 55 crore. This means the banking system is no longer limited to big cities and large corporate houses. It is spreading into villages, small towns, MSME borrowers, gig workers, and first-time credit users. For Japanese banks, this is a stage where growth has only just begun, not one where saturation has already arrived. That is exactly why Japanese financial groups do not want to remain limited to large corporate banking. In India, they see potential everywhere. Retail credit, vehicle finance, SME funding, asset management, investment banking, M&A advisory. MUFG's Shriram Finance deal and its investment in DMI Finance point in this direction. DMI Finance announced MUFG's additional investment in 2024, making it clear that Japanese lenders want to go deep into India's digital lending and retail finance ecosystem. If you look closely, Japan's strategy is not simply to invest money in India. The real strategy is to build the next growth platform through India. That is why Mizuho's Aventus deal is also important. By connecting commercial banking, investment banking, and advisory into an integrated platform, Mizuho is trying to help Japanese clients enter India and Indian clients expand into global markets. This is exactly the model Kato openly said they want to make successful. But the second part of the story is even more interesting. Japan's own economic limits. Japan has long been struggling with the problem of being a mature market. Banking penetration there is already very high. Most households and corporates are already part of the formal financial system. The population is not growing. It is shrinking. According to Reuters, In 2024, births in Japan fell to a record low for the ninth consecutive year, while deaths crossed 1.6 million. World Bank data shows that the population aged 65 and above in Japan has risen to more than 29% of the total population. In other words, society is aging, the workforce is shrinking, and a natural ceiling is forming over domestic loan demand. After decades of ultra-loose policy, the Bank of Japan began raising rates, and by the end of 2025, the policy rate had reached 0.75%, close to a 30-year high. But growth equations do not change just because rates rise. Reuters and BOJ materials both indicate that Japan's long-term challenge still remains demographics, weak domestic demand, and limited room for expansion. In other words, even if margins improve a little, the banking sector does not get explosive new demand. In such an environment, overseas diversification becomes not a luxury, but a structural necessity. This is where the stories of India and Japan seem to complete each other. Japan has capital, technology, process discipline, manufacturing know-how, and long-horizon thinking. India has market scale, demographics, digital rails, entrepreneurial energy, and the possibility of credit expansion. One has money but limited demand. The other has demand, and its infrastructure is being built rapidly. This chemistry is what makes Japanese investment in India so logical. The China factor cannot be ignored here either. China slipping to 6th place in the JBIC survey is not just symbolic. It is a strategic signal. Geopolitical tensions, supply chain concentration risk, regulatory unpredictability, and China plus one thinking have forced Japanese firms to search for alternative bases. India is becoming the natural beneficiary of this search, especially at a time when it is continuously pushing semiconductors, electronics, renewables, logistics, and manufacturing incentives. Cato also specifically mentioned sectors such as semiconductors, materials, and renewable energy, where Japanese expertise and Indian scale can come together. That is why the money flowing from Tokyo to Mumbai is not just a stock market bet. It is a multi-layered investment into infrastructure, finance, advisory, consumer credit, digital finance, and industrial partnerships. Japanese institutions do not just want to participate in India's growth story. They want to become part of its architecture. When a mega bank buys a stake in a local lender in India, acquires an advisory firm, and signs a joint financing pact with an Indian bank, it is not merely investing money. It is buying influence, network, and long-term access. This has deep meaning for India as well. The first benefit is capital inflow, which gives greater depth to the domestic financial system. The second benefit is governance and process standards, because Japanese institutions are known for risk control and disciplined capital allocation. The third benefit is sectoral know-how, especially in manufacturing, mobility, energy systems, industrial materials, and structured finance. The fourth benefit is trust signaling. When some of the world's largest Japanese financial groups place billion-dollar bets on India, it sends a powerful signal to global investors as well that India is no longer just a potential story, but an investable story. But like every story, this one also has risks. India's growth is impressive, but the challenges are not over. Crude prices, geopolitical shocks, global trade friction, regulatory pace, and execution bottlenecks can still have an impact. Reuters recently wrote that high oil prices could put pressure on India's current account, inflation, and growth outlook. So yes, Japan's bet on India is very promising, but it is not risk-free. Still, large institutions usually go where there is risk, but where the reward is even bigger. Another important point is that Japanese money usually does not go into India for short-term speculation. Its nature is comparatively that of patient capital. Insurance groups, banks, strategic investors, and industrial houses often focus on long-term partnerships. That is exactly why the idea of an India-Japan financial corridor matters. This is not about next quarter's earnings. It is about positioning for the next decade. If you look at it through a broader lens, this may be exactly the kind of moment that economic historians later call a turning point. Just as Japan once built a deep industrial footprint in Southeast Asia, it now appears to be viewing India as the next major growth platform. The difference is that this time, the game is not only about factories, it is also about finance. Bank branches, NBFC stakes, M&A platforms, wealth management, trade corridors, digital payments compatibility, and cross-border advisory are all together creating a new economic axis. And perhaps the most interesting thing is that this story did not emerge suddenly. For years, India-Japan diplomatic ties, infrastructure cooperation, supply chain conversations, and trust building have been preparing the ground. Now capital is landing on that ground. Earlier, bullet trains, industrial corridors, and strategic dialogues made headlines. Now banking stakes, finance partnerships, and advisory acquisitions are making headlines. That means the relationship has moved beyond symbolism and reached the balance sheet. So the next time you see a headline saying a Japanese bank bought a stake in an Indian lender, or a Japanese group invested in a Mumbai advisory firm, do not see it as an isolated deal. Behind it, a much larger calculation is working. Japan is stepping out of its shrinking, aging, low-demand home market and building a place inside the economy where the population is young, demand is rising, digital pipes are ready, and the credit game still has a long way to run. And the name of that economy is India.
If our video has taught you something new, do not forget to like and share this video so that this information can reach others as well. Your likes and shares are a source of inspiration for us. If you have any questions or suggestions, please let us know in the comments. It will be our honor to answer your questions and listen to suggestion. And yes, if you like our content, subscribe to the channel and press the bell icon so that you stay connected with every new story. Thank you. GRT Business YouTube channel sources: news from various news agencies, opinion polls, and other public sources. We try to ensure that every report and summary is accurate and verified, but we are not responsible for any dispute or error. Our aim is only to provide you with accurate information.